You guys, last year was our highest income earning year ever, and yet we paid the lowest amount of taxes we've ever paid. In fact, we got $14,000 back from the IRS and we got $2,000 back from the state of California. How is that possible? Through the magical fairy dust of real estate, through a process called depreciation, through an accelerated process called cost segregation, by me qualifying myself as a real estate professional. In this video, I'm gonna tell you exactly how I did that, how the cost segregations work, where I went to get the reports, and how much I was able to deduct from my homes so that I actually ended up deducting a total of $247,000. You didn't hear me wrong. Stay tuned. Hey guys, welcome back to Lifestyle Leaps, where I help you take big steps to achieving financial freedom, early retirement, and so that you can do the things that you love, like traveling the world maybe. But I try to do that using my own experience, and today I'm gonna share with you a pretty big life-changing experience that I had last year where I was able to use cost segregation to create big, massive passive income losses through my real estate business and apply it to active income like my W-2. We were able to massively reduce our taxable income, and as a result, we got almost $16,000 or a little over $16,000 as a tax refund between the IRS and the state of California. So in this video, I'm gonna explain to you how that process worked for me. The first key factor to understand is that passive income loss does not offset active income loss in the eyes of the IRS. So if you have passive income activity over here and you are at a negative for the year, that negative will not offset your W-2 income, let's say. However, there is an exception to that rule, and that is if you qualify for real estate professional status. And in order to qualify for real estate professional status, you have to meet certain criteria. And so let's go over that now. So since I'm not a CPA, I'll take you to this website, and I'm gonna link it in the information below the video. But here's an article from the tax advisor, and it explains the real estate professional status. So essentially, coming down here, it says to be a real estate professional, a taxpayer must provide more than one half of his or her total personal services in real estate or real property trades or business in which he or she materially participates and performs more than 750 hours of service during the tax year in real property trades or business. So essentially it's saying that you have to spend a majority of your time in real estate, materially participating and performing more than 750 hours. There's going to be other specific criteria too, but that is the general gist of it, and that they want you to keep an ongoing log to demonstrate this. Another point is that they would typically treat each real estate property separately, but you're going to want to have your CPA elect to have all of your properties treated as a singular unit, because there's no way I'm actually spending 750 hours at one single house throughout the year in terms of managing it, running it, and getting it rented or fixing or repairing, right? So you're going to want to make sure that this is the case. Now, once you are a real estate professional, what next? Well, that now means that you're able to qualify to take any losses that is generated from your real estate activities and apply those losses to offset your taxable income from your W-2 income or any taxable active or non-passive income, right? So that means that you have to then maximize your losses over here to offset your earnings and taxable income over here. And that's where depreciation and write-offs come in. So obviously through a home, you can depreciate your home by splitting up the value over 27.5 years and depreciating that each year. You also have business expenses that you're going to write off, but that's going to likely be less than your depreciation. Now, you can massively accelerate your depreciation through a process called cost segregation, where you break out all the components inside of the house and you're able to depreciate those much faster than you would at the rate of the rest of the home, which would be at the 27.5 years. Cost segregation, typically you could have someone come out and do a cost segregation report, your real estate investment property. And that would be very common, except for if your value, which is the purchase price minus the land is left over is your house value, right? So if that house value is less than $600,000, you can actually get this report done online without someone coming out to the home and doing the inspection for probably thousands of dollars. Instead, you're going to just pay a few $100s for this report. Now, don't be scared off by me saying few $100s, because this few $100s saved me tens of thousands of dollars, and I'm gonna show you right now. My CPA actually introduced me to this company, and I'm not affiliated with them. I just used their services and they really helped me out a lot, because from here you can purchase a report for a residential cost segregator, but down here it looks like it's able to give you a calculator to give you an idea and preview before you want to buy the report. But if you do want to buy the report, then you can purchase the report by clicking here, and it takes you to this tab over here, and I can show you the price at this time of the recording. It looks like if you get 1 to 9 reports, it's $450 each. But don't sneeze at that price, because I'm going to show you what that's worth. This is the report, the official report that it gave me for my Phoenix house. And you can see here that first of all, I purchased the Phoenix house for $460,000. And based on the summary of the information that I inputted into the system to create this report, the additional tax deductions for year 1 that I was able to take is $117,275. What does that mean? That means that I am able to apply this deduction to my real estate business, which will create a loss at the bottom line, right? And then I'm able to use that loss to then offset against my earnings of my W-2. A couple things I should point out that are important. Well, one, I'm not a CPA, so this is not tax advice. The second thing is that depreciation is, although magical, it is not free of consequences. So any depreciation that you take off of rental property to reduce your taxable income, when you go to sell the property and you get money back, well, at that point, it is going to be taxed as regular income. So there's no real concept of like completely tax-free money poof into thin air. It is recaptured somehow. However, there are ways to continue your investments so that you don't ever have to have that happen. For example, for me, I only do the cost segregations on properties that I plan to either A, keep forever, or if I were ever to sell that property, I would do a 1031 exchange and roll over the proceeds into another investment vehicle, into another investment property. And therefore, that just carries on into the new one, and I don't have to then pay taxes at that point because I actually never got my money back. You know, all that to say, there's amazing tax opportunities within real estate, but it is a long game and a forever game, and unless you want to be taxed at the end of that. So for us, our game plan is that the properties that we cost segregated last year, which we did it for 3 properties, those will always either be in our portfolio or will be upgraded through a 1031 exchange and stay within our family and passed down to other generations and will continue to be tax-free forever. That's our hope. Something else interesting that I learned was when I did my second cost segregation for another property, our Portland property, that actually cost more at the time of purchase than the Phoenix property. But yet the amount that we were able to deduct on the first year was actually less on the Portland property than it was on the Phoenix property. I was thinking to myself, why is that the case? Well, I realized our Phoenix property has a pool, has substantial fencing around the house, and the materials inside the house were more expensive. And that actually is very consistent with the concept of cost segregation, right? Because cost segregation is actually breaking down around the elements of the home from the home itself to depreciate sooner. So with all of those extra elements comes a larger depreciation line item compared to our Portland house, where it didn't have a lot of fluff or any extra amenities that came with the house. In the end, we ended up doing a cost segregation for 3 properties last year. I didn't plan to do all 3. I was only going to do cost segregation reports on 2 of them. But by the time we got to the end and we ran all the numbers, we realized somewhere along the line, either myself or my CPA had miscalculated something. Gross taxable income wasn't as low as I had planned it to be for some qualifying purposes that I had in mind. So we needed to lower that amount more, and luckily I had another home that I hadn't done a cost segregation report on before. So I was able to use that home and do a cost segregation to bring that taxable income down low enough to where I needed it to be. And that's what tax planning is all about, except we have an epic fail in this situation, but we figured it out. The other component to that I wanted to share is that only one partner in a marriage needs to be the real estate professional to qualify the partnership for these benefits. So last year I was the real estate professional, but this year, because we retired Jake last year, now he has all the time in the world, and I've moved on to now creating this YouTube channel, spending a lot of my time with building my social media platforms. Check me out on Instagram and TikTok if you haven't yet. But that frees him up, so now he is spending a majority of his time doing the real estate professional work criterias. And as long as that one of us meets those criterias, we can continue to do that. Now, you don't have to be a real estate professional status to use cost segregation. But you do need it in order to use the losses of passive income to apply to active income, which was really important for us last year. And we will continue to use that this year because we still have losses this year as well. From, as you can see in that report, it showed you years 2, 3, 4, and 5, what additional deductions that you can take. That's really cool, right? You only need one partner to make it happen. This is a very complex concept. This is actually a pretty sophisticated investment and tax strategy within real estate. So I definitely did not do it justice here and did not provide you enough information, but I wanted to give you an overview of what we did last year in my really layman's terms and really simple way of explaining things. So hopefully you can at least get that light bulb going in your head if you haven't heard of this strategy before, and move into the direction of learning it more on your own so that it's this big tool in your tool belt. One thing too, a piece of advice is that don't feel overwhelmed by all the things that you learn in terms of strategies, tax loopholes, real estate information, because it's just this little nugget that's in the back of your mind, and you will whip it out when you are facing a situation where you can use it or find it beneficial. I learned about cost segregation and all these tax loopholes years ago when I first started to learn about real estate, but just an overview. And so by the fact that I just knew that it was available, a piece of information that was a possibility, it allowed me to move forward with my real estate investing, knowing that when I think that those pieces of information would serve the most valuable or beneficial to me is when I really then started to sink my teeth into whatever that was applicable to me at that time. So don't feel overwhelmed. It's just an extra piece for you. I hope you find it beneficial. Please like, subscribe, and comment, and I'll see you next time. Bye.